That was a long list of elements that we have to consider in order to decide what's the correct valuation on a stock. How are you doing it?
Well, I think at this point in a market cycle, it's incredibly difficult. I mean, you asked the question, have we ever seen anything like this before? And I think that perhaps the size of the moves are a bit outstated, but the reality is that there is, at this inflection point, whether that be uncertainty about what the Fed's going to do from themselves, right? Uncertainty around where these earnings are going to come in. And I think that the growth rate that supports that are all at these change points. And when that happens, you're going to see volatility around that. So what I don't think is unusual is that we're seeing the vol that we've got right now. It's perhaps the size of it, and particularly in fixed income, as Garfield noted.
Yeah, exactly. Well, you know, I sometimes feel like we're in the upside down, and not just for that reason, but also for the reason that, you know, we're seeing strategists change their minds. So Mike Wilson has suddenly said, you know, we could see profit growth from meet expectations if the economy continues to be resilient. Marko Kolanovic, though, continues to say, look, too many red flags. They see, JP Morgan sees the S&P 500 at 4,200 at the end of the year. What's your call?
So I think they both can be right.
Yeah.
In the sense that in the near term, the U.S. economy and the global economy, for that matter, is still reasonably strong. And so we think that here in the next couple of quarters, earnings can probably deliver, and they probably need to deliver in order to support the valuations that we've seen, even with the pullback. I think our concern is, as we look a bit farther out, that there's plenty of red flags. We had been overweight equities for a very long time. We still are modestly. But as we've started to see some deterioration in that macro outlook, if we've seen the deterioration in investor sentiment that used to be very positive for stocks and a little bit less so now, all of those things have said to us, we still want to tilt to stocks, but we've pulled that back pretty significantly.
What about the Magnificent Seven? That's been the only play. Are investors turning against the Mag 7 now?
Well, I think that we've seen from a results perspective that the Mag 7 is becoming the Mag 5.
Yeah.
So that's part of it. And I think what we have to see in this earnings period here is that spread and that breadth, because if that doesn't happen, then we're going to be in a market that's probably a bit more vulnerable. I would say, though, as much as we've seen the movement in the stocks, and they have been outsized in many of those 7 companies, when you look at the valuations that they have relative to the growth, they've delivered, right? NVIDIA is the poster child for big moves, but they have continued to deliver on the earnings piece of it. And so, obviously the concentration is a concern, but the fact that it is being followed up with companies coming through with that, need to moderate the concern.
You can't fault that,
Yeah.
right? Exactly. Now, you still see 3 to 4 cuts this year.
Yeah.
How do we get 3 to 4 cuts with the economy holding up so well?
So I think that there's a piece in that, Vonnie, that's a question of what are they probably going to do versus what we think that they should do.
Yeah.
Right? So market's pricing in 2 cuts. We think that maybe we get to 3. But we do think that what happens if that is the numbers that we get to is that the Fed is actually going to put themselves a bit in the corner. If we look at what's happening between CPI, a year ago this time it was up close to 4.8, it's down closer to 3.8 today. Fed funds still 5.5 in both of those situations. Core PCE has come down quite precipitously. We just think the Fed's very restrictive right now. And if they delay, as markets and economies start to slow, that's going to put them in a very difficult position. Probably not so much in 2024. Our call is not recession in 24, but potentially in 25. And if they get too far behind the curve, what could have been a short and shallow recession turns into something a bit deeper.
How come economic strength is holding up so well? I mean, it's been more than 2 years now since the Fed started to move.
Yeah. So I think that there's been a couple pieces to that. One, from a corporate perspective, companies did a really good job of showing up their balance sheets and their income statements. They refinanced their loans 2 years ago when rates were low. So I don't think that they have fully felt the impact of the Fed's raising their rates. And so that has helped drive some of the profitability that we've seen. It's helped allow them to be a bit more resilient. I also think that when you look at what we've seen in employment, that has continued to be strong. And so all of those things have kept the consumer in a pretty good position. I would say, though, that if you start to look at some of that data, you start to see some cracks there. Right? So the mix between full-time and part-time employment is starting to see much bigger growth in part-time. Average hourly earnings, hours worked, right? Job openings are being cut, which are basically stealth layoffs. Right? All of those things, I think, from our perspective, back to your point about red flags and warning signs, those would be in that camp.
Now, you mentioned that you're less overweight U.S. equities. You're also overweight cash at the moment, but you like high yield still, which I think is interesting. And also I want to examine your call on gold, which is also overweight, even though we're seeing gold come off the boil now.
Right. So high yield is admittedly an interesting one.
Yeah.
I think part of that has been driven by the fact that, again, the environment has been pretty good for risk assets. Ours is not a call that we think spreads are going to tighten much from here. In fact, that is a concerning part of this call. However, given where we are from a growth point of view, not really concerned about defaults as much, and the fact that the carry you get on high yield relative to other pockets of fixed income, we'd rather clip that coupon, and we think that's a way for investors here in the near term to add to return. On the gold side, that has very much been largely a technical call for us, and so admittedly the last couple of days have been a bit more challenging for gold, but we do think that there has been enough of that will continue. Interestingly, you've also seen such incredible amounts of buying from central banks around the world, right? And almost 2 tons in the last 2 years. And so while that perhaps starts to come off and may take some of the bid away, we do think it puts a bit of a floor there because those tend to be more permanent holdings that can support it as well.